Hi, and welcome to Hedge Fund Tips. I'm Tom Hayes, and you're listening to our 21st VideoCast and 11th podcast for the week ending March 13th, 2020. Thanks for joining us. What an exciting week in both directions. Day by day, we're going to kind of go through it as quickly as we can here and get you the most amount of information in the least amount of time. So here we are on Monday. The market was collapsing. Want to thank Paul Vigna, Avantika, Chilcote, and David Winning for including me. This was on the front page, so I'm really grateful for that. And basically, they were asking, what's going on with the markets. It was crashing that day. And the fear about today was global recession. If Russia doesn't come back to the table soon, investors will worry about the default risk, and credit spreads widening will lead to a tighter credit and even a recession. And that was really the key about last Friday's surprise with OPEC falling apart. And even I was much more concerned about the credit markets with credit spreads getting tight after the Russia debacle than coronavirus, because coronavirus, as challenging as it is, and it's obviously a human tragedy, we know there's a light at the end of the tunnel. We've now seen China, Disneyland just reopen their park in Shanghai. Apple has now opened 100% of stores. They were at 85% last week. I think they got 42. Starbucks, 100% of stores are open. You look at the pollution maps, you see people are back in action. So China has done really well. They got a late start, but they got it back. South Korea is now getting back, getting good indications and getting things contained. And they got off to a rocky start, but they picked it up. Singapore nipped it in the bud in like 4 or 5 weeks. And so we knew it was just a matter of time how to get it contained. And boy, was today a dose of confidence with that 3 o'clock meeting. But we'll talk about that in just a minute, the press conference from the president. So this is how we came into the week. It wasn't the coronavirus. It was certainly this OPEC debacle. And I want to thank Michelle Macquarie for having me on Monday. I'm going to play a clip from this where I explain so I can set the context, because it was a perfectly wrapped bow from the beginning of the week to the end of the week, the president's conference today. So let me give you a little context with what I had to say on Monday.
Facility with Thomas Hayes. He's the chairman and managing member at Great Hill Capital. Reeling from this day, Thomas, how much of this was Corona? How much of this was what we're seeing in the crude oil market? Or how much of this was just a very bad, potent combination of the two?
Well, it was 86.12%, the OPEC meeting falling apart for sure. But in that ballpark, it was really about 80%. And if you think we took it bad, 7.5% down, we're down 19% from our recent highs. Take a look at Russia. They were down 16% their equity markets today, 35% down from their recent highs. Saudi Arabia was down 17% today, 33% from their recent highs for their equity markets. So if their intent was to punish the shale producers, what they miscalculated was that we have a very dynamic consumer. 70% of our economy is consumer driven. And on Russia's side, they're really focused on oil. So the real risk and the knock-on effect of what happened by the OPEC Plus meeting falling apart on Friday, which did obviously surprise the markets and surprised a lot of people, is that people are scared of credit markets freezing up. Okay, so if you look at the high yield index in the United States, it's heavily weighted to energy stocks. And when people now say, the cost of production is in the low 40s, when these companies start defaulting, people look at what banks have exposure. And actually, there were some good stats put out about which, the kind of exposure they had. It's between 1% to 3% for the major banks, so it's not material. It's going to hurt them more than it's going to hurt us.
So if this move, as you say, could land up backfiring on Russia, can they backpedal? Can they change this now? Or is
Absolutely.
It too far gone?
And, it's funny that you bring that up. I think basically, I don't know if it's another 5% when their equity markets are down 40%, or if it's 15% and they got to go down 15%. But I do believe Russia's going to cry uncle. And if not, I think you could see a situation in Saudi Arabia where you could potentially have a change of leadership if something doesn't change very quickly. When the pressure gets this acute, though, it's often the point in time. Today was real capitulation. I mean, people were just deleveraging, getting out of stuff. That's when you usually see change, and whether that's going to be a change where OPEC comes back to the table or the Saudis say, hey, we'll bear more of the brunt, just come along for a bit.
But given where we are with the coronavirus picture and the impact that's having on the global economy, even if there is a reversal with the oil price, how much of an impact is that going to have?
Yeah, well, I think, we saw, if you look at the China model, so as their new cases leveled off, if you look at the chart of the new cases, the moment their new cases leveled off in early February, you saw their equity market rally 23%, while our equity market was declining because we were just getting new cases. So, today in New York, I'm coming down here, everyone's running, everyone's outside. Warm weather doesn't cure it, but it makes it a little bit more difficult to spread, and that's going to be helpful. So there are a lot of positive things happening. Rates are low. And by the way, the Fed stepped in the past week, which I've been kind of writing about in the last 2 months. They stopped providing liquidity and increasing their balance sheet.
Okay, so that was the bit about OPEC on Monday. So that was really the fear, is the contagion in the credit markets more than anything else. And by Wednesday, I went on Yahoo Finance right after the bankers meeting at 4:15. And I talked a little bit more. You can watch the whole thing if you want to see the stuff about the stock market and what stocks we were buying and that type of thing. But I talked about a solution to the OPEC problem here. So take a quick listen to this clip.
But that's something that could immediately quantify it, and the whole game was changed. Then you had, the whole Russia thing over the weekend, and that blew up the credit markets. So it blew up in the sense that it rattled the credit markets. Credit spreads blew out, and that could get quantified. If you remember 2016, these things, they're always different, but they have similarities. OPEC balked on cuts, if you remember, in early 2016, and then they came back to the table. And that's when they got the rally. And you know who were the big buyers in 2009 when WTI went down to 33, and 2016 when it went down to 26? China stepped in and bought it at $30 a barrel. We should be stepping in. We've got 100 million barrels of capacity in our strategic petroleum reserve. We could step in tomorrow, save 250,000 jobs in the oil patch, stabilize the credit markets, get OPEC back to the table, have time for this drug to come happen, and we could be off to the races. Or we could just focus on the problem and go lower. But we're nibbling on bargains.
Lots to think about.
Okay, so that was on Wednesday at 4:15. And this was President Trump's amazing speech today in the Rose Garden that really gave the markets confidence. We're going to talk about a lot of things that gave the markets confidence, but I think this is one of the key aspects that people aren't quite absorbing the positive implications of moving forward just yet. So take a listen to President Trump.
Oil, I've also instructed the Secretary of Energy to purchase, at a very good price, large quantities of crude oil for storage in the U.S. Strategic Reserve. We're going to fill it right up to the top, saving the American taxpayer billions and billions of dollars, helping our oil industry and making us even further toward that wonderful goal which we've achieved, which nobody thought was possible, of energy independence. It puts us in a position that's very strong, and we're buying it at the right price. And that's something that would have not even been possible a week ago. The price of oil went down quite a bit, so we're going to fill it up. It's a good time to fill it up. I'd like to ask Mike Pence to say a few words, please.
Okay, so they totally, and we're going to see this over the next week. I think a couple of really amazing things can happen out of that. Number one, they've got 92 million barrels of capacity. So if you look at the coronavirus estimated demand destruction was about 900,000. That's when China was offline. Now they're coming back online, but we're slowing down. So let's call it 1 million barrels a day. We could basically cover the deficit for 3 months until demand naturally picks up, number one. Number two, I think the side benefit you could get if Russia and Saudi Arabia are really smart is they're going to say, you know what? U.S. is meeting us part of the way. They're going to pick up 92 million barrels of oil. Why don't we do 1 million? Why don't we go ahead and, meet them halfway and do 1.5 million a day of production cuts like we had planned on before things broke down. Because here's the thing. Everyone's like, oh, Putin wants to bankrupt the shale producers so that they can control the market again. Let me tell you something, guys and gals. The assets aren't going anywhere. Unless he's going to suck our fracking sand out of our country, basically you bankrupt 20% of our shale producers, guess what? Sam Zell and all the private equity guys under the sun come in with their dry powder, they buy those assets, and they put them right back on the market. So if their plan was to bankrupt the shale producers, all they're going to have is leaner, more efficient, non-debt laden owners within 6 to 9 months pumping that stuff back out. So their better play is to now use this opportunity. The administration has extended an olive branch. It's great for the taxpayer. And by the way, knowing, President Trump, he likes to buy low and sell high. I'll bet he lays this off on the market a year from now if oil's back at 55, 60, and he's going to make the taxpayers probably a double, $3, $4, $5 billion of profits for the taxpayers. So this is just an absolutely brilliant idea from the administration, and I think that they are going to deserve a ton of credit because, number one, the high yield market, as I said on Michelle Macquarie, thank you again for having me on, and Adriana Guzman from I-24 News, thank you both for that. This is going to be really constructive for the credit markets because it's going to calm down the high yield market because the default risk is going to go down, and that's what you started to see right before the close after this was announced. Absolutely amazing. And by the way, it's going to save a couple 100,000 jobs in the oil patch, which is just huge. But they're not going to bankrupt shale producers. They're just going to transfer ownership to without the debt. So basically, they're going to get more production because the new owners that are going to buy the assets out of bankruptcy are going to be able to pump more because they don't have all the debt overhang. These guys, at least, they got to service their debt, so they have to control their capital expenditures. Russia wants to keep these guys in business if they're smart. If they're dumb, they think that you never want to try to take share in a declining demand market. That's, people say economics 101. It's economics 102. So I think that Saudis and the Russians have gotten an amazing olive branch here from the administration. They should jump onto it, add 1 million or 1.5 million on top of what the Trump administration has just proposed with 92 million barrels that they're going to put to bed into our strategic reserve. And we can get energy price oil back up to $50, $60 a barrel, where it's great for the consumer, it's great for the producer, it saves jobs, and just an amazing positive development this afternoon. Next, Pelosi, House Speaker Pelosi said that they're going to do a deal, so we're going to get fiscal stimulus in the U.S., which I have to say, and I did on Fox today. I'll play the short clip on Fox. What Mnuchin did this morning by coming out, he basically reminded me of Mario Draghi during the Euro crisis. Draghi came out, all these bond vigilantes were shorting sovereign bonds, expecting the Eurozone to break up or trying to force it to break up. And he just came out and he said, we're going to do whatever it takes. Basically, if you're short, you're toast. We're going to be the buyer, and we've got a bigger balance sheet than any of you combined. And it stopped it dead in its tracks in 2011 after a 20-some-odd% correction and choppiness. He came out with the bazooka, and boom, we rallied. So Mnuchin really has not only done an amazing job with the China negotiations, but what he came out today and he highlighted the 1.5 trillion of liquidity that Chair Powell came up with yesterday, the $60 billion of bond buying. Basically, they're going to increase the balance sheet, quantitative type easing. But that's a good thing. They're buying on the short end of the curve, which, by the way, guess what? Should affect a steepening of the yield curve, which will help the banks, which have just gotten battered in this thing. Wells Fargo's down 50%. They're not going to do 50% less business. It's just like last summer when the yield curve inverted. Everyone was afraid, the net interest margin. This should steepen the yield curve as they continue with this. And he basically said, he pulled a Draghi this morning, even though he's a Secretary of Treasury versus a central banker, but he's got the gunpowder, and we're going fiscal this time, and that's what the world's been waiting for. that he's going to do whatever it takes. The liquidity will be there, and he really changed things on a dime. So hats off to Secretary Mnuchin for what he did and what Chair Powell has done this week. They've increased the balance sheet, and they're going to keep going and do whatever it takes on repo and increasing the balance sheet. So kudos to that. And we did this short clip this afternoon right before President Trump came on from the floor. So take a listen here.
Firmly still in a bear market right now. What, if anything, can the president say to pull the markets out of this week-long tailspin? To our floor show traders, guys, we're teeing it up in front of the president. You've been on the market's front line. Tom Hayes is at the NYSE, Phil Flynn at the CME. Tom, what market indicator will you most closely be watching as the president speaks?
Well, we saw extreme fear yesterday, Liz, and they always say, when no one's worried, that's the time to worry. Well, yesterday, everyone got worried, and they came out with massive action. Mnuchin reminded me of Mario Draghi during the Euro crisis when he said, whatever it takes this morning, and he committed $1.5 trillion of liquidity. The Fed chair did yesterday, $60 billion of bond buying, and fiscal stimulus to come. And he said, this is just the beginning of fiscal stimulus. So that imparted confidence in the market. And, you know, here we are down 25% off the highs. Kenny Rogers has a song, no one to hold them, no one to fold them. Historically, you haven't been paid very well for folding at 25% down. So we've been nibbling in the market on high-quality names. You know, names like Wells Fargo that are down 50%. They're not going to do 50% less business next year than they did last year.
Of course.
We'll get through this.
Okay, so so that was Fox. Thank you to Ellie Terrett and Liz Clayman for having me on, and also on Yahoo Finance. Thank you to Miles Udlin, Jen Rogers, and Dan Roberts for having me on that clip. So next, guess what else came out tonight after the close? Europe pledges billions in economic aid, a rare sign of unity, a total of $41 billion of fiscal stimulus for small deficit spending for small and medium business and workers. So you can read this in the New York Times. It's happening, guys. And you know, this I put out on Sunday. I think it was Sunday night, the 8th. So either Sunday night or Monday. This is Bullish percent transports. And I said this was interesting because it's basically the percentage of stocks in the transportation sector that are on what they call a PMO buy signal, or bullish. Anyway, it just basically means that they're showing bullish tendencies. So basically, we got down today on the 8th, about a week ago, to 0. Okay, there have only been 2 other times we've gotten down to 0. That's where the pessimism level was. December, Christmas Eve of 2018, when they also had the bankers call, and then the market rallied. We had the bankers meeting on Wednesday rather, and look what happened to transports afterwards. It took off. And then in the middle of the crisis, March, a couple weeks before, 1 week before the bottom in 2009, transports got to 0, and look what happened after. So I put this out on March 8th. I guess that's either Sunday or Monday. Okay, I was just going through my normal weekend work, so it must have been Sunday night. The futures were down 1,000. That I remember now. And the last 2 times that bullish percent got to 0 for the transports were March 2nd, 2009. We bottomed a week later, and Christmas Eve. So what I was saying with the futures down 1,000, it's hard to see how we turn here with all the pessimism, but that's usually when something comes around from thin air. What catalyst could be coming? What could the catalyst be in the coming weeks? We don't know, but here are some ideas. Gilead's remdesivir has proven effective in the phase 3 test and rolled out for mass human use to treat COVID-19. That hasn't happened yet. But we are seeing more and more anecdotal cases of people that have been helped with that. And also the AbbVie HIV antiviral as well. That was in the New York Post. We put it in today's reads. You can check that out at the website. 2, Russia comes back to the table with OPEC Plus and they implement cuts. That hasn't happened yet. 3, the Fed meeting. Well, they kind of pushed the Fed stuff up. They've been increasing the balance sheet. I know they did $100 billion in the last week. Maybe they've done more. I didn't look at it today. And 4, this is what actually happened this week. This was the most important. I thought it would take the longest. That came the quickest. Global coordinated fiscal stimulus package announced. That just happened tonight in Europe. And it's coming from Speaker Pelosi, and Mnuchin crafted a deal with Mitch McConnell, and one other person was involved. Anyway, you can Google it. But, they're all working together, and they're all getting it done. All these countries in Europe, all these different parties in the United States. I mean, in a crazy way, maybe this is what we needed to bring the country together, but we're getting it done, and that's all that counts. And then I said, well, all the scenarios seem low probability. Looking at the futures down 1,000+ points, it's frequently at these points of acute pessimism that something changes in the near term. Time will tell. So there you go, and you can calculate how bullish percent is calculated here. The next thing I put out on Twitter on the 12th, which was yesterday, was a similar thing. It wasn't bullish percent for transports. It was bullish percent for the S&P. Got down to 1.60 when I put this out. I think it got down to 1.40 last night. Last time it got down to 1.60 was like fall of 2008. It wasn't the exact low of the crash, but it was near it. So I actually put this one out without an explanation at all. I mean, it was what it was. And by the way, no one is calling bottoms here at all. No one can do that, but you just, as I discussed in last week's VideoCast podcast, some of these stocks are starting to price in what would be the worst case scenario. Wells Fargo down 50%. I mean, are we going to close down for 3 months and have no business? Yeah, that's possible. But for Wells Fargo to justify being down 50%, you'd probably have to even close longer than that. I mean, and especially as you got closer to the light at the end of the tunnel, the market would start to discount what's coming, not what's in the rearview mirror. Right now, this week, the market was discounting what's coming, and that's an economic slowdown in the short term until we contain this and get back to work, like you saw in China. And the key, as I said on Michelle's show, was that the minute you see, the first day you see cases level off, new cases level off, meaning they're the same as the day before or slightly less, the Chinese equity market started to rally in February. It rallied 20 some odd percent once that stat came in. And why everyone's been nervous and why the market was down so much is because we're just kind of ramping up. So we want to, get the numbers. Now we've got the testing. I can't believe what they pulled together in a week with Google going to do the web. Can you imagine if you don't feel well, you go to this Google website they announced today at the president's press conference, and you type in your symptoms, and then they tell you where to go to get a drive-through test to see if you have coronavirus. And then you get the results in 24 hours. That is just mind-boggling. How do you pull that together in like 3 days? This is just amazing. What I saw today was really exciting. Does it mean it's the exact bottom? No. Could we go 5 or 10% more? I don't know. But I do know that if Wells Fargo's cut in half, if I look 2 years out, I don't think it's going to be half the business it is today. If I look at Pfizer, which is down 25%, yielding 5%, I don't think people are going to use 25% less medication a year out. If I look at Berkshire Hathaway, that's down 20%, when Warren Buffett has told you where he's willing to buy his own stock, and he's got, I don't know what it is, it's 80 to 100 something billion dollars of cash, chances are, he's going to be buying his own stock at these levels at some point. Maybe he lets it go another 10% if he senses fear. But, we've been getting involved for the last week. You can look at all of our media. On every red day we've been adding, and every green day we've been sitting on our hands and doing nothing. So today we did nothing. Yesterday we were adding. And we'll see. We put out about 7 or 8 out of 10 slugs that we wanted to reallocate. Hopefully we'll get a few red days when we can put the last 2 or 3, and then we'll sit on our hands and see how it plays out over the next year and a half. But there is real opportunity out there. And you probably won't get the perfect bottom, but if you start, and then if it gets a little weaker, you can add a little bit, and just conservatively, not recklessly, just start to ease in. Okay, now we're getting to our main article of the week, and we've covered a lot of this, so hopefully I can get you through it quickly. The sky is falling stock market. We put this out on Thursday morning. It was really a sky is falling day. I think the futures were down, 700, and then the market just fell apart, 2,000 points down. And as I said over and over, quote, notice I did not call the bottom, but rather laid out a rational plan about how we're thinking about risk and valuations moving forward. It could get worse before it gets better. Well, it certainly did yesterday. Whew. That was a rough one. As a matter of fact, there were a lot of rumors. I think Bloomberg put an article. Something was unnatural about yesterday's deleveraging, and people are tracing it. People are saying it was risk parity. They always blame risk parity, but sometimes it is because they're so levered in different asset classes, and their algorithms trigger if they hit certain volatility levels. They start puking out certain assets, and they do it all at once. And they're highly levered because they have like what they think are non-correlated assets, and volatility hits and correlations go higher than they think they will in their models. And I think what you saw yesterday was much more than people just being worried about whether or not certainly, the NBA closing down spooked people. It's when, took it from being hypothetical to being real. Like our lives are going to change for the next few weeks. So that was part of it. But there was something unnatural about yesterday. And I think there might be some merit to that rumor that Bloomberg put the article about risk parity. So let's hope that was that. And, we take it day by day. Next, so the catalysts. So by Thursday, I had listed a few more catalysts than I was talking about on Monday. Remdesivir. There's also the AbbVie drug that was in Kaletra, which is a combination of two antivirals. You can look up that here. Be in the know, 13 key reads. No, it was 13 reads for Friday the 13th. You can find it at the website. It's there though. Or just go to the New York Post website and Google coronavirus antiviral or something like that. Next. Okay, so Gilead didn't happen yet. Russia didn't happen yet. Fed meeting didn't happen yet, but they actually came out yesterday with massive action. Global coordinated fiscal stimulus just happened today. And what's interesting about what Mnuchin said about it, this is just the beginning. This is just the first fiscal stimulus. We're going to have package after package after package. This is pretty amazing. China added $100 billion of liquidity. Good news. China steps in as a buyer of oil. Well, I'm sure they're in the market, but now we're going to be in the market, benefiting as well as taxpayers and saving 250,000 plus jobs, saving the credit markets, and getting an asset really cheap that we could always lay off down the road at higher prices if we want to do that. Like it. President Trump, buy low, sell high. Great job on that. And 7, okay, so I put this in yesterday as well. U.S. administration could add to the strategic petroleum reserve at these prices and sell it when the market stabilizes. Okay, so that we put out yesterday. Here's what's really exciting about this whole thing. Now, this does not belittle, we got to go through the valley here. I was in New York. It was much more active today. It was much more active than I had expected. Like, people are out. Very few people are wearing masks. It was beautiful out today. The warm weather is a good thing. So it's nice to see that. People are in the restaurants, less so, but there was traffic on the Henry Hudson. That's good. I've never been excited about traffic. I've never been excited about pollution in China. It's picking up. That's good news. That's never been good news. Now it's good news. And traffic on the Henry Hudson has never been good news. I was happy to see it today. I got to be honest with you. Okay, so what's really great about this is that as we get through the valley, the demand pickup and the recovery will just be kicking in at the same time that the global monetary and fiscal stimulus is starting to filter through the system. And that's really going to set the table for a nice back half recovery. So you just got to have faith. It's tough. They're going to do stuff like you saw in Europe, help the people that are hourly wage, small and medium businesses, backstop them so people don't lose their businesses, people don't lose their jobs. They have money. They're going to figure out a way to get this done. We're going to see more of this over the weekend. Help out those people. They've done it in Europe. We're going to do it here. And then once we get through this, it could be things could, certainly the back half, I think is going to be very promising. But I think this is going to be less bad than people were anticipating yesterday. So, but still take all the precautions. I got dry hands. I'm washing my hands, just doing the elbow bumps, no fist bumps, follow the CDC, take it seriously, check in on the elderly, call people on the phone, see if people need groceries or supplies, step in, do all the things that we do as a community and family and all that stuff. We got to do that. There's no way around it. We got to go through the valley here. But they've given us the tools today to really feel good about going through that valley together. So, okay. The other thing is, there's no question late Q1, Q2, maybe certainly Q2 earnings are going to be hit from the slowdown. But what's interesting, so FactSet hasn't taken down earnings. Earnings are going to come down for 2020. They still have them at 175. I think Goldman put out 158. They're probably a little too negative. FactSet's probably a little bit too positive. But, they're going to be less than we expected in the short term. But, the 195 earnings for 2020, I don't see any material reason why that shouldn't hold up. If anything, all this demand, a lot of this demand is going to be pushed forward. Certainly, if you didn't go out to the restaurant, you're not going to eat twice in one night to make up for it. But for a lot of the other things, if you didn't buy an iPhone this week, you might be buying it 5 weeks from now. So some of this demand will be pushed forward. And, maybe 2021. And as we get past June, July, the market's going to start to discount 2021 earnings. And even if they come down a little bit at $190, we're trading really cheap here. It's the 2020 earnings that we don't know. And, I was thinking about what to say going on today. I was going to say, it's kind of like driving in the country where there are no street lights and all of a sudden your headlights of your car go out. The first thing that you do is you stop your car because you don't want to keep driving and hit something if you can't see anything. And that's really what I think we saw in the markets yesterday. People don't know what the E is in the price to earnings ratio. And so rather than drive around in the dark, they just hit the brakes and they wait. But here's the good news. If you get stuck in the dark and you have to wait in your car because you can't see, sooner or later, guess what happens? Morning comes. And then you can see without your headlights and it's the dawn of a new day. So certainly as we get through this, it's going to be dawn and we're going to be able to see even though our headlights are out. So we'll get through this. Next. The China recovery model could replicate globally. We went through this, okay? Disney's reopened, Apple's reopened, Starbucks is reopened. The minute those new cases level, they had a huge rally while we were going down, and we're going to see that one by one in each market. So we just have time, patience. But, they really showed us today that we've got the tools we're going to need to get through this, and hopefully quick like Singapore. I know we're much bigger landmass, and there are a lot more fragmentation, but to see all those CEOs up there and just, taking the test time down to 24 days after a week, it's just amazing to see what they're doing. So we won't belabor this. No one can pick the bottom. We don't know. It could get worse before it gets better. But, high quality stocks, Berkshire down 20%, American Express down now, I think 35%. Maybe it rallied at the end of the day. Wells Fargo was down 50%. Pfizer was down 25%. And these are things, Wells Fargo today was yielding 7.5%. So, okay, if it falls another 10%, you're paid to wait anyway. Berkshire doesn't have the dividend, but Pfizer does over 5%. You're paid to wait. ExxonMobil, their dividend is 9%. What's everyone afraid of? They're going to cut the dividend. So they cut it in half. You're at 4.5%. The stock's down 50 some odd percent. And by the way, if the shale industry is going to consolidate, who's going to be the beneficiary when an industry consolidates? The biggest player is going to be the beneficiary, and they're trading down below great financial crisis lows. So, you take these things for what they're worth. You don't go all in like a maniac. You just, each red day, you can add a little bit and take advantage for the long term. Okay, so that's that. I also pointed out in this article, read Warren Buffett's article here from the New York Times op-ed, October 16, 2008, and how he was thinking about, that crisis and how we got through. The other thing, by the way, that I didn't write about this week, did you know that in the Spanish flu, which is the model everyone's scared about, obviously the technology wasn't there, etc., to contain anything, but they lost 50 million people from the Spanish flu. The Dow only corrected 37%, and that's when 50 million was a ton of people, by the way. It still is, obviously, but something to keep in mind, knock on wood, we're not going to see anything remotely that devastating with this. The technology's there, the forces are mobilized, but we fell 28% at the lowest when all that deleveraging, I think that was mechanical deleveraging late yesterday, was going on. And we're not going to see anything like that kind of situation in the Spanish flu, knock on wood. But it just puts things in perspective. Now on to the shorter thing. This thing, okay, the AAII sentiment didn't really get as low as I would have liked to see. But it was done as of Tuesday night. And I think Tuesday was a big up day after the Monday crash. I think that's about right. Monday was a down day. Tuesday was an up day. So maybe people were a little more optimistic. But the bearishness did get up to 51%. Ideally, you want to see this get down to 20%. My guess is if they took this survey last night, it would have been down to 15%. So that's that. The fear and greed got down to 4. I think it got down to 1 last night. So, I mean, that's about as low as it gets. It's paid to buy here and sell here over time on average, on balance. You can look at the CNN website and see how that all works. This was as of Wednesday. The active managers took their exposure all the way down and, into ranges that are, it wasn't the exact bottom in December of 2018, but we were getting close and then we recovered. So it just tells you they got scared, and that's understandable based on what's happened. And as we said over and over, we can't call the bottom. No one can. It could get worse before it gets better. But we're selectively and slowly adding to those stocks and sectors which are nearing valuation levels that we define as pricing in at or near the worst case scenario. Most stocks do not yet meet this measure, as the worst case is unlikely to materialize, but for those that do, we're adding and will continue to do so as opportunity presents itself in coming days and coming weeks. So that was Thursday morning, and we followed our advice that day. And that's that. Next, we did that. This was on Sunday. Sam Zell's buying in the energy patch in Chief Investment Officer magazine. He's been buying like us since October on weakness. Hasn't worked. Wrong in the short term. I think it's going to be right in the long term. And, we added another 2% this week after the Russia blow up. And we'll just sit on our hands, and see how this plays out over the next 2-3 years. But it's generational. And it was interesting. Yahoo Finance had an exclusive with Warren Buffett this week. And the question was, are you worried about demand? And he said, I'm not worried about secular demand. And I've said that in my past pieces. Renewables are going to be a greater percentage of the pie, but the overall demand is going to go up over time. And that's why he got involved. He was talking in the context of Occidental. And by the way, Icon, who's also a big Occidental holder, was a huge buyer of Occidental this week and went on CNBC today to talk about it. I didn't get to see all of it, but he said he could take his position from 10 to 15%, even though they put the poison pill in. So, you get Sam Zell in the game, Warren Buffett in the game, and Carl Icahn in the game. I want to be involved. And it may take a year. I might be wrong for a year, but I'm going to be right in 3 years because A, I'm following money that's much smarter than I am. And B, I just like the math. So that's how I'm thinking about that. So patience. I would have loved to see it happen sooner, but, later is fine with me too, especially when the survivors are going to be up, 2 to 3x and some of them even more. Now going on to sector earnings we do every week. We did the top 30 weights of the retail sector, last 60 days earnings power. These numbers are all going to change, but they were up 2.2% in the last 60 days for 2020 estimates. On the retail side, obviously that's going to change. Transports were, top 20 weights were down 4.43. That's no surprise. Energy was down 13.6% in the last 60 days. The stocks are down a lot more than that. So, you play the spread and hope for the best. And then this was today. So, thanks again to Ellie, Terrett, and Liz Clayman for that. So that's about it for this week. It's been a up and down week. There'll be a lot more to talk about as the details come out on the stimulus and the announcements from the press conference, but we really ended on a high note with that the president's press conference at 3. I think he started around 3:30 after I got off. the floor. And what an amazing group he's assembled to help combat this challenge. And it really gave me a lot of confidence in what they're doing. And I think it did to the country as well. It certainly was reflected in the market. Looking forward to seeing you back next week. Same time, same place. In the meantime, stay safe. Reach out to people who need help. We'll get through this and have a great one.